Basically, this report is saying that if we leave things as they are, investors are taking a $6 trillion punt over the next 10 years, that governments won't do what they say they're going to do about climate change, and in some cases, like the British government, have promised they're going to do in law about climate change. That's a very big risk to take, and what that figure is, of course, is what the oil, gas and coal industries will be investing over that 10-year period if they continue to invest at the rate they did last year, which, without recognizing the risk of the carbon bubble, they will do.
The report repeats the earlier research that we finance more fossil fuels than we could possibly burn to stay below 2 degrees warming. And that creates a complete paradox for markets and for participants. The second is the capital expenditure, how much capital is being spent each year in exploring for new reserves. So they lead to two things. One is, if we can't burn these reserves, is there a valuation problem with the public companies? And the second is, should shareholders be asking companies to return cash to them as investors to be deployed elsewhere?
Two things struck me from the Unburnable Carbon report. The first was the sheer scale of reserves within listed oil that potentially could be unburnable. Approaching 80% of their reserves might be non-monetizable. The second thing was the marked difference in carbon intensity between the US market and the UK market. The UK market has a far greater bias to coal, and as a result has probably about twice the value at risk as the US market does.
Basically, there's a fundamental contradiction here. You cannot believe two things simultaneously. You cannot believe that we have a reasonable chance, even a 50-50 chance of holding to 2 degrees. You cannot believe that and believe that hydrocarbon companies are anywhere near valued at the right price. You just can't believe both those things simultaneously.
I think this report is absolutely fantastic. I think it should be read by every chairman and every chief investment officer of every UK pension fund. UCB, a new acronym, Unburnable Carbon, but actually it's all about, it's not an asset, it's a liability. And that doesn't seem to be priced in or really thought about by many people at the moment.
In terms of regulation of the fossil fuel industry, I think there is no question, as the report suggests, there needs to be more disclosure. I think there needs to be more disclosure about the types of reserves these companies have, not just the proven reserves, which is the current standard, but the probable reserves and possibly even the resource base. I'd also like to see more detail on the value of those reserves, particularly the developed and undeveloped split, because if we think about it, if unburnable carbon is going to be a problem for these companies, it is going to be the undeveloped assets that are keys.
My role is to look after our pension fund, and we have already adjusted our strategy of how we invest our assets. So we take account of climate change.
We're fascinated to see how the Bank of England react to this report. They've seen our first report, and now with the second report and the compelling evidence that's in it, really I think they're responsible for financial stability, the stability of the capital markets. That's one of their key roles as regulator. Right now they're allowing the carbon bubble to go on inflating with nothing done, and I think that's got to change.